The board sort of reflects the aspirational quality of the organization, what you want to become, the markets you want to represent, and so on. At the same time, financial institutions as a business require boards that are increasingly technically competent in understanding the business in a way.
Yeah.
So how would you describe your board, and what would you put your finger on to make sure that the composition of the board is rigorous and responsive?
I think it's a profoundly important question. I think the board is an extremely, well, needless to say, it's responsible for the overall governance of the company. Its role is absolutely critical to ensuring that a bank plays its part properly and profitably in society and in economic development. So its responsibilities are extremely onerous. That's the first thing. Board members need to recognise that they're taking on a very serious responsibility when they become a board member of a company like HSBC. I think you need to have a board that is representative of the geographic spread of the business and of the functional competencies that you need. Clearly you need audit competence, you need technology competence, you need, I believe, in a bank that's in personal banking, a sense of retail marketing. You need city financial expertise. So there are a variety of needs that you have, and you also, in a case of a company like ours, need to have Asian representation for obvious reasons, European, America's representation. You need that geographic spread. The result of all that is that our board is quite large. In fact, it's 21 members at the moment, of whom 6 are executives. Well, myself as chair, and then 5 executive directors, and 15 non-executive directors, including a so-called senior independent director, which is the UK term for what Americans would call the lead director.
Right.
And I believe it to be a very good board. I think it has very deep competence across all of those areas of expertise that I mentioned to you, and is a good international spread. It's very difficult to make it a small board and cover all of those bases properly. But I think it's a very good board, it's very cohesive. I can attest to you that it's a board that is very proactive in involving itself in understanding the proposals that management put up, the strategy that management is seeking to follow, prodding and probing that and making sure that the outcome is in the real long-term interests of the shareholders.
Given the fact that you have to have all that spread in order to have a board that represents the global nature of your business, is there an optimum size, a kind of a size that works beyond which really it's unwieldy?
Well, clearly there comes a point where when any group for discussion and decision making becomes unwieldy. I don't believe we're at that point. I believe that at 2021, which is where we're at, is fine. And indeed I don't think you could reduce it significantly for the reasons I've just been talking about. You shouldn't grow it significantly either. I think it's about right. And I, like I say, I attest to you as the chairman who has to actually make sure the meetings work well, that this is a very cohesive, contributive, and prodding and probing board, which is what it should be.
Do you have problems when you invite people to join your board these days? Are there people who say that, no, I don't want to be a board of a bank because it's too difficult?
Well, I mean, we've done a lot of refreshing of our board in the last 3 years. If you look at the membership 3 years ago and compare it with the membership as of now,
as I
there's
noticed,
been quite a lot of change. I have to say that these are people who are very fine, very high quality people who have been very pleased to join the board, and we're extremely delighted and honoured to have them on the board. So I don't think we've had an issue of attracting the right levels of experience and competence and vision onto our board. I think it's gone extremely well.
Basel II brought us to a point. What do the financial services industry professionals need to look at post Basel II going forward?
I think there are a number of issues coming out of the crisis. There are 2 that I would draw attention to. I mean, and these are a matter for the regulatory community as well as for the banks themselves. The first is the fact that the way Basel II and the accounting standards operate at the moment is plainly pro-cyclical. Something's got to be done about that. I believe that at the very least you've got to smooth it out, and I think there's quite a strong case for making the capital adequacy regime counter-cyclical. In other words, capital is being built up in the good times and not run down in the good times, which is the way the system currently works.
But do you think the dialogue's taking place at the BIS?
It's beginning to, yes.
It's beginning to demonstrate that.
Yes. No, I think it is. And the other thing is about liquidity. If you look back, and again, I think everybody would acknowledge this, not enough attention was paid to liquidity issues, the management of liquidity in the go. And these two issues are, of course, linked. Too little capital converts itself into a liquidity problem. Illiquidity can lead to capital being wiped out. It's very important to look at these two issues together. As I say, looking backwards, a lot of the regulatory focus in the boom years wasn't enough regulatory focus on liquidity. That's clearly now changed. Regulators are very focused on liquidity issues, quite rightly too. So going forward, I think there has to be a renewed focus on liquidity, and there is work to be done on this, an approach to capital adequacy that makes sure that it's at the very least not pro-cyclical, and that we're not running down capital in the good times in a way that is plainly imprudent.